One of the biggest tax advantages associated with real estate is depreciation. In this video, I'm going to explain all about how it works and how you can use it to your advantage as an investor. So let's get started. The first place for us to probably start is, what is depreciation? We've heard that term thrown around, but what exactly does it mean? I have the definition pulled up here, and it says depreciation is thus the decrease in the value of an asset and the method used to reallocate or write down the cost of a tangible asset, such as equipment, over its useful lifespan. So to make it super simple, anything that we can touch and purchase, so like a pen, a car, this microphone, has a value, one, and two, it has a determined useful life, meaning how long it will last. So this pen may last a year, it might last 2 years. This microphone, hopefully, it lasts 3 years, right? And so over time, it's going to decrease in value and it's going to break down. And so essentially what happens when we talk about depreciation, it is the cost of that degradation over time. Great thing about that is that it's a non-cash expense. So you didn't spend any money, but you get to take the deduction. Do note though that it's essentially a loan from the IRS that you're able to take deductions now, and then upon selling that property, you will have to pay taxes later. There are ways to go around that. I actually have a video talking about a 1031 exchange that you can click the link here to watch a little bit more about how that works. But for the most part, and for our conversation at this point in time, you have to keep in mind that depreciation is subject to tax and repayment once you sell the property. That said, it is super beneficial. I have another video that you can click the link here, which walks through how depreciation works and how it can impact your tax liability further. So that's what depreciation is. Now, second question is, how is it calculated? When it comes to taxes, there's traditionally two ways that it's treated. The first way is MACRS, and the second way is straight line. There are some other methods, but for our conversation, it's not necessarily important to speak about those. So MACRS is an IRS prescribed method of accounting for depreciation for various classes of assets. How do we determine the life? The IRS also gives you guidelines on how long assets are good for. So for example, residential real property is depreciated straight line over 27 and a half years, whereas appliances or cabinetry may be depreciated over 5 or 7 years. Now, I mentioned straight line when it comes to residential real property, and what that means is that if you have a property worth $100,000 and you are taking depreciation on that property, well, you'll take $100,000 divided by 27 and a half, and essentially over a year, you'll take equal portions of that property until it's fully depreciated. Now, with the 5 and 7 year assets, we get to do some fun things. We get to take something called bonus or Section 179 deductions in relation to that, because that can be particularly helpful when we're trying to do tax planning. And for example, if you know that there's a huge tax bill, you might want to pull that depreciation forward into the current year to offset that bill. So I think you're starting to understand how this can work for you. But I want to just expand upon this and explain what happens if you are an active real estate investor. And when I say active real estate investor, that means that you have rep status or that you are using the short-term rental loophole. When that happens, well, you have just thrown gasoline on your depreciation expense and how it can benefit you and really impact your tax liability in a big way. So if you have active status and you are depreciating significant amounts of assets between the property and the appliances and fixtures that you've put into your rental property, but you also have another business that is active income and you generated income in that business, well, all the losses that you've accumulated and generated through your rental properties, even if it's cash flowing, because remember, depreciation is not a cash expense. So even if it's cash flowing, you could still be in a loss in terms of your rental properties. And so we take that rental loss, especially if it's active. So if you have that rep status or if you are taking advantage of the short-term rental loophole, and then you go ahead and offset get that income from your business. So let's just do some quick math so you can understand how this works. Let's just say that you have $100,000 in income from your business, but then you also have rental real estate and you generated a loss of $50,000 and you took advantage of the short-term rental loophole. Well, now what's going to happen is that those two numbers are going to be added together. So essentially you'll take the $100,000 of business income and subtract out the $50,000 of real estate rental losses, and now your taxable income isn't $100,000, it's $50,000 because of that depreciation that you've been able to pull forward against your rental income. So this is a super powerful strategy that really can work very, very well if you are intentional about planning how to use it appropriately. If you want to learn more about how you can use depreciation even further, I have a video on the channel that walks through an example of what depreciation looks like and how it impacts you from a tax liability perspective, and you can watch that here. And then I also have a video here that talks about cost segregations and how cost segregations really can light a fire in terms of depreciation expense and be an excellent way to save when it comes to taxes.